I like to say it's a hurricane over real estate right now, hovering over the entire industry until we get some. And they're like, we hear all this noise about the real estate, but we don't see the issues. And there is going to be a serious credit contraction. I think the housing market's had a very unusual situation. I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
Get ready for a real estate update from none other than Barry Sternlicht, a big shot real estate investor. He's not just successful, he's a billionaire and the brains behind Starwood Capital Group, a massive investment fund handling over $120 billion in assets. Picture this. One of the world's largest real estate firms? Now, why is this a big deal? Well, because Barry, being the CEO, has an inside scoop on what's cooking in the real estate market. In a recent chat, he didn't just hint, but practically shouted about a Category 5 hurricane about to hit the real estate scene. And it's just months away. But hold on, I'll spill the details in a sec. Before we dive in, don't forget to hit that subscribe button. I'm here to make you a top-notch investor by learning from the best in the business.
Talk about your other business, which is the non-lodging business. So you are one of the best known and one of the best real estate investors in our country. Right now, many people think the real estate market's going to be in trouble because high interest rates are making it more and more difficult for people to service their loans, and we're going to have a lot of defaults soon. What do you think about that observation?
Anything with a fixed income stream is worth less when rates rise. And the underlying fundamentals in most of the asset classes in real estate are okay right now in the United States. The apartment market, the industrial logistics market, the hotel markets, those are all in good shape. But there's no question that the Fed has reacted dramatically to try to slow the economy down quite late, obviously. And that has impacted real estate values. Yields on properties are moving up to reflect this higher interest rate, and the supply of credit to the industry is curtailed dramatically. So I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some.
To truly get the scoop on what's happening in the real estate world. Let's break it down. It all starts with a dance between real estate values and interest rates. Real estate is like a money-generating buddy that throws you a fixed income party every year. A fixed income stream is like your buddy promising you a steady amount of cash year after year. You're the proud owner of an office building, and your tenant signs a 10-year lease. Boom, you know exactly what you're getting in rent for the next decade. That's your fixed income stream. Now here's where Stern's wisdom kicks in. He said any asset with a fixed income stream loses value when interest rates go up. Let's make it relatable. Imagine you're the boss of a small apartment building in your town. This place rakes in a cool $100,000 in cash every year. That's your annual income stream. But hold on, that cash isn't all yours. You've got some bills to pay. Think maintenance, property taxes, management fees. The works. So here's the plot twist. If interest rates start doing the cha-cha upwards, your apartment building's value takes a dip. It's like your money-making friend suddenly throwing a curveball at the party. That's why keeping an eye on interest rates is crucial in the real estate world. They can make or break the value of your income-generating property, but it's probably not going to stay that way for much longer, as per Sternlicht's insight.
Your view is because of the kind of things you see coming, we will go into a recession in the United States, in your view?
Yeah.
And any way to avoid it at this point, or not really?
It's interesting. One of my friends had a meeting with one of the governors recently, last week. And they're like, we hear all this noise about the real estate, but we don't see the issues. They're going to come, and there is going to be a serious credit contraction. The country, in any asset class, has not adjusted to that cost of capital yet, but it's coming. The economy will slow. You can see the numbers. CO confidence is down, consumer confidence is down, retail sales are down, service economy is wickedly strong. It feels like the last gasp before we actually settle into what should be what you'd expect to be. I hope it's a shallow recession. I hope he can pull that off.
Normally, when you increase interest rates, you decrease GDP growth and you increase unemployment. Your point is unemployment's not going up because the statistics aren't really covering the people who are really being laid off?
Unemployment isn't going up because structurally interest rates aren't affecting the labor market the way they would normally affect the labor market. You have the offset in construction from the infrastructure bill, and you have the service sector, which is still recovering the pandemic, which normally...
All right, imagine you're in the real estate game, looking to make some smart moves. Here's the deal, you snag an apartment building and every year the rent goes up by a cool 5%. Fast forward 5 years and you decide to cash in by selling the building. Now, in the world of commercial real estate, the magic number is the cap rate. This little gem tells you the yield of the property over 1 year if you bought it outright without any loans. Here's the formula to find out what you can sell that building for in 5 years. Take the cash it generates a net operating income if you want to sound fancy and divide it by the cap rate. Let's say we're rocking a 5% cap rate for this example. Now here's the kicker, how do we figure out what that apartment building is worth right now? Simple, take all the cash it's going to churn out over the next 5 years. And then in financial wizardry fashion, discount it back to today. And there you have it. Your value-packed rent increasing, cap rate calculating, real estate adventure. So imagine your apartment building is like a money time machine, thanks to something called the time value of money, linked to interest rates. At a comfy 6 interest rate, your building is valued around $2.28 million. But hold on, let's see what happens when interest rates decide to party and go up to 10. Boom! Your building's value drops to $2.18 million, a cool $100,000 less. But wait, there's more. Because of the interest rate hike, the cap rate fancy term for how much profit you want also needs to climb. Investors want a bigger piece of the pie. Bump up the cap rate from 5 to 6, and suddenly your property's future selling price in 5 years drops from $2. Nothing changed about the money your building makes, but higher interest rates made it less valuable. The real estate market's doing well now, but with rising interest rates, things might shake up, as Sternlicht suggests.
Work from home phenomenon is a US phenomenon. If you go to England or Germany, and we have some investments offshore, and I was just looking at rents are up and vacancy rates in the top German property markets, Berlin, Frankfurt, Munich, Hamburg, are less than 5%. People are back in the office. You and I go to the Middle East, they're full. We have offices in Asia, they're full. So this is a US situation. In the US, you have two markets. You have the really nice buildings that are ESG compliant, that are lovely, like the one we're sitting in. This place is buzzing, and they're back because it's a fun place to be. And if you're in a building with lots of cubicles and it's dark and there's no life and love, so nice buildings, even in a city as currently destitute as San Francisco from an office market perspective, the best buildings are still leased. And so you're going to see a bifurcation of the market in office. The nice buildings will stay rented, and my guess is at pretty good rates. And the B and C stuff is going to be maybe fields of grain or something. It'll be very pretty. We'll have all these little mid-block parks in New York City because there won't be anything else to do with those buildings. And nobody will carry them because there's no hope. Some of the cities that have issues on commuting, like New York or LA downtown, San Francisco, the CBD, that are difficult to commute to, that's where the pressure's so hard from workers saying, I don't want to drive into the city an hour and a half and drive home an hour and a half every day. But I also think a nice little recession will clear this, and you'll see people come back to the office. And I was in your town, take the Amazon HQ2, they're expecting people in those offices 4 days a week come the fall. So the other thing about office, David, is AI. AI is going to hit a couple of these industries that have been big.
Real estate is like a fancy term economists use for something called a commodity. Now, the price of any commodity depends on the whole supply and demand dance happening at that specific time. Let's talk about it in simpler terms using our earlier example of the apartment. We already figured out that the building's value is tied to the money it brings in. But what sets the rent you, as the owner, can charge for each unit? Well, that's where the supply and demand for apartments in that real estate market come into play. We've got a graph with 2 lines. One line is supply, which is basically the number of available apartment units in an area. The other line is demand, representing the number of people looking to rent apartments. Now, where these 2 lines meet is the magic spot meets the price, or in our case, the monthly rent for those apartments. Now, when demand's crazy high compared to the supply, we call that having strong fundamentals. In recent years, the economy has been rocking low unemployment, government throwing in some stimulus cash, and home prices going through the roof. This meant more folks wanted to rent, not buy, and our demand line shot to the right. People might end up moving back in with their folks or sharing a place with roommates to save on rent. Some might even face eviction if times get tough. Evictions can be a headache for building owners, eating into their cash flow. A weaker economy usually means less demand, as we can see with our demand line going south. But here's the twist. During good economic times, investors want to build more apartments. The catch? It takes a while for these projects to turn into rentable units, like 12 to 24 months concurrently. We're looking at a whopping 560,000 new apartment units entering the market in 2023, the highest in 2 decades. Construction kicked off in 2021 and 2022 when things seemed brighter. Now, with more apartments available, our supply line moves to the right. The point where our supply and demand lines meet drops to a lower price. This example focused on apartments, but there are 2 real estate classes catching attention. Here, first up, we have office buildings. Sternlich talks about how remote work is shaking up the office market. Stay tuned, things are getting interesting.
A recession there because prices are going to come down at some point, or you don't see a recession in housing?
I think the housing market's had a very unusual situation where Powell's increase in rates has diminished supply, and I'm not sure we've ever had a situation where so many people have locked in their mortgage costs. So right now people are sticking in their house, which has diminished the supply of homes for sale. I wonder when rates come down, homes will be sold, like people will start, because the mortgage will no longer be a reason to hold on to the house, and whether that will offset will probably be an increase in supply. As the builders resume a more normal cycle. So maybe the housing market just stagnates for a while, but over time it's headed up.
Picture this, most office workers aren't really vibing the idea of spending the whole work week in an office. And guess what? It's causing some serious drama in the office space world. Companies are realizing they don't need as much space as before. The situation is so wild that tons of office buildings, once bustling with workers, are now looking at emptiness. I mean, we're talking ghost town vibes. Take San Francisco, for instance. Vacancy rates are through the roof, hitting nearly 30%. That means 30% of all office space in the city is just sitting there, twiddling its thumbs. Now, not all office buildings are in the same boat. They're like movie ratings, but for offices A, B, or C class. A is the cool kid, and C, well, not so much. The fancy A-class offices are still in demand because, who doesn't want a nice place to work? But here's the juicy part. It's the poor C-class buildings that are taking the hit. They're all chilling in less cool neighbourhoods and nobody's really into them. In fact, things are so rough for C-class buildings that sometimes it's just cheaper to bulldoze them down than keep them hanging. We shift gears to houses. The single-family ones are getting some attention too. This big shot, Stern, who owns over 3,200 houses, is keeping a close eye on the housing market. It's like a real estate soap opera, drama everywhere. Okay, so check this out. The housing game in the US is going through the roof. Not in a good way. I found this chart from Goldman Sachs that's like a history lesson in home affordability. The lower the number, the tougher it is for your average Joe to snag a house. Now, why is this happening? Well, 2 big reasons. First off, home prices are going through the roof. I mean, in June this year, the median price tag for a house was a crazy $416,000. Compare that to $315,000 back in 2018. Prices are just shooting up. But wait, there's more. The second reason is the sneaky rise in interest rates. Back in 2021, you could lock in a 30-year fixed mortgage at a sweet 2.65. Fast forward, and that rate has skyrocketed to a whopping 7%. That's a game changer. Let me break it down. With a $400,000 mortgage and a 2% interest rate, your monthly payment is around $1,478. Cool, right? Now let's crank up that interest rate to 7%. Suddenly, you're shelling out way more. And so it's like a double whammy, crazy high home prices, and interest rates shooting through the roof. No wonder folks are worried about a housing bubble. It's like buying a house is turning into a high stakes game. Keep an eye on this. It's getting interesting, to say the least. Our monthly payment shot up to $2661 due to a higher interest rate, causing an 8% increase despite keeping the loan amount the same. Now, you'd expect these rising interest rates to bring down home prices, right? Surprisingly, that's not happening. Here's the twist: who bought homes? when interest rates were low, find themselves in a bind known as golden handcuffs. They're reluctant to sell because doing so means losing that sweet low interest rate. This scarcity of homes for sale is like magic in the supply and demand world. When supply drops, prices keep going up. So we're in for a bumpy ride in the real estate market, according to Stern Lake. He suggests the next 12 to 18 months might be tough for many. But here's a silver lining. Lake talks about surviving till 2025 or 2026. If you can weather this economic storm, there might be fantastic opportunities on the other side. Hit that subscribe button, because my goal is to transform you into a savvy investor by learning from the best. Catch you soon.